we had 18 total owner finance deals for the whole year, and the average sold price was $410,000.
Yeah.
So this is a big part of that market. So maybe walk me through what's causing people to do seller financing, owner financing. I think there's some obvious points in here, but
I think there's some, if you're in the position to carry the note on owner financing, it could limit your exposure to downward pressure in the housing market, but still, through owning the note, carry some kind of interest, right? If it goes wrong. So worst case is you kind of end up back with the property that you already owned, hypothetically, right? I mean, there's always a worst case, but, a likely poor case, I guess. The other thing is you can potentially have some tax strategy in something like that for when you realize gains, depending on where your cost basis is at and stuff like that in the property. The other thing you can do is sometimes sell your home for more than the market would normally pay, right? Because it's all just a function of, right, price and terms, sort of thing. So by allowing somebody to get it that they couldn't qualify otherwise, right, you're kind of now writing essentially a subprime mortgage on the property yourself, and you're taking on that risk. So that could be for savvy, investors, that could be a play. And I think more people are wanting to look for that because the closing costs on that are oftentimes less than conventional methods. And so they think, hey, I can get into the property and then I can refinance, when rates come down, next year or 2 years, right? I've seen, I know I've talked to several people that have done some of those 48 deals, and it's not uncommon to have a 5 or 7 year balloon that they have to refinance out of that home. And so if you're a buyer, I would say be really cautious about that balloon, just in the event that, interest rates kind of stay where they're at over that time period and the property value goes down. You want to make sure that you have the ability to refinance out of that loan, because there may come a time where if things change in your life, that balloon's going to be due, and it's going to be due either way. And it's
going to be subject to an appraisal. Right. So if let's say
it's going to be subject to an appraisal,
even in 2 years,
it's going to be subject to also you qualifying with your income at the time. Right. So if your income fluctuates a lot over the next 5 years, again, if appraisal comes in low and you don't have the cash to make up the difference, right, that could be a concern, all stuff. And on the other end of that trade, remember, you have the prior homeowner that was likely happy and content with that property for the most part, and you've made payments this whole time. So they've continued to get their cash flow that they were looking for out of the property. And now there just comes a time where they can say, oh, I'll just take it back.
Yeah. They get all that money and then they just take it back.
So
I think there was some predatory stuff went on in 08 where those rates. Hold the phone on 08. I mean, I know there's predatory stuff going on in our market currently. So like, I think even as a seller finance, I think there's a limit to what. First, I think there's a limit. If you got a conventional loan, I think the bank can technically call it due if you are doing a seller financing. Technically, they could call it due, right?
Yes. And also,
if they find out you're doing that,
yes,
it's possible.
And also, I believe there's some terms that you actually have to, if you're going to write the mortgage on a residential property, you have to look at some of the same guidelines that a bank would have to if it's somebody's primary residence. So if it's an investment property, I believe that's sort of waived and you can kind of do whatever. But if it's going to be somebody's primary residence, there's some due diligence that you have to do, I believe. So if you're going to be the seller and offer seller financing, it might sound really good, and you can use a third party escrow to service that loan. Right? There's companies in town that do that, but also consult with your attorney to make sure that you're also not breaking the law.
Right. Yeah, I would put my money on not necessarily just
I think
taking a real estate agent's word for it.
Yeah, don't take a real estate agent's word for anything when it comes to seller financing.
Seller financing is a little bit more complex.
As a real estate agent.
And a bunch of real estate agents are probably going to be like, oh man, you're being overly worrisome on this. But
if you're going to be on either end of a seller financing transaction, pay the money to have an attorney review the contracts.
Make sure your risk is mitigated on this one, because it makes me nervous, right? You see those 48, you see a big jump, 18 properties before, 48 now. Last year's 18. This year there's 48 properties. We're talking 39 million in volume that's moved in Washington County over seller finance. I can't help but think how many of those people are in a better situation than if they would have done something differently. You know what I mean? And so that's one of my concerns with seller financing.
Yes, I think oftentimes that can be the case. I'm surprised that we don't see more up there, but I think that what people are finding is that, seller financing is not all it's always cracked up to be.
Yeah.
Right? It's a unique tool, but that doesn't mean it's for everyone. So everyone would love to buy something on seller financing, right? But why would someone want to sell on seller financing, right? And if they do that, oftentimes it's because you're going to pay more for their house, right? Like there's just always that trade-off, right, of price and terms. Price and terms. Yep,
absolutely. So if we were to transition kind of quickly to mortgage rates, because I think demand is really what's driving that seller finance. I think you're having people come to sellers and saying, would you consider this? Because if I go to a bank, these are the terms that I'm stuck with. And hopefully I can negotiate with somebody that has a lower rate that locked in, 2 years ago. And now there's a delta where that seller, it makes financial sense for them to do it. So now the demand is really probably what I've seen the increase on. Jeff, remind me, like, how many have we gotten on that one property on Dover Lane? How many seller finance offers have we seen?
Yeah, so they're all subject to, and there's...
Subject to
4, 5, 6.
Subject to, maybe just clarify.
Yeah, so it's people scrubbing data on loan limits versus potential equity and stuff like that.
And so we've had multiple seller finance that come to the seller and say, hey, we'll give you seller finance terms, and the terms are really not really in the benefit of the seller, truthfully at this point. But the amount of increased traffic of people calling us and saying, hey, what would you do for seller finance on this?
Right. Again, price and terms. So, hey, you can sell your property for a little bit more than, the rest of the market would pay, but you have to carry that risk of writing the note, right? And have it being subject to and the complexities of that.
Click on the chart.
Because, as agents, we all know that if we drop the price on a home low enough, the market will just buy it, right? Somebody will come up with cash. Somebody will come up with a, qualified for a conventional or an FHA loan, and they'll buy it, right?
Yeah, right there, Jeff.
So if you have a property listed and all you're getting is seller finance terms, and they're kind of bad terms in your favor, it probably indicates that your home's a little overpriced.
So I think
you can sell it again at the seller finance terms, but you're taking on more risk.
So we kind of gone the macro route, right? We looked at what's the market doing as a whole. We've seen prices go up month over month, but generally have been coming down since 2022. The mortgage rates, though, looking in terms of a buyer, as we settle into demand, rates just over the last basically month have pulled back almost a full percent. So what was that? 8% mark? Now this is a Mortgage News Daily website is that we're looking at, and this is an index of these rates. So this isn't everybody's specific rate is going to be unique to them based off of a bunch of different factors: credit score, debt to income ratio, history in general, but their qualification is going to determine their rate. So this is just looking at an index of all different kinds of loans that have been going out. So they look at this index. Their index says that overall we were at 8% in October 19th was that peak, and then we've seen rates ping pong down, up and down, all the way until we're at 7.1% right now as an index goes. And I think
point down.
I think the index, at least the daily, because they kind of give a daily market indication, is that we're still seeing pressure go downwards on the rate, right? Was that what I was reading, Jeff? Negative impact, meaning, or is it going up with that? It says MBS prices are significantly weaker. So far today, this strong downward movement in MBS will most likely result in higher mortgage rates for today. So we're seeing the market start to put upward pressure, but we're talking about a couple basis points. But I think it's interesting that the Q4 we saw rates pull back, which is what I think we talked about a couple months ago. It's like, hey, when historically
Halloween trade.
Tell me more. What do you mean by Halloween trade?
I don't know how much I can get into it on this podcast.
Okay.
Somebody can look up October effect.
October effect.
But there's a seasonality. Jeff, don't look it up right now, man. We
have to be careful, right?
There's a seasonality trend. And you layer a couple other things together. The demand for bonds in the market went up, right? Which means the yield went down, which means what you can get a new loan at is going to be a lower interest rate as a consumer, right? So mortgage rates have a correlation to the 10-year treasury, right? So it's kind of a 10-year treasury plus a premium. So it's not the exact, it's not always the exact rate, and it's not always the exact same premium, but there's a correlation. And so if there's a demand in the market for 10-year treasuries, that means the price of 10-year treasuries goes up, but that means the yield on them goes down, which then you can buy you can essentially take out a new bond or mortgage with a lower interest rate today, right?
Go to the jumbo,
as those have come
jumbo
down.
too.
Now, whether or not those stay low is up for debate, but I think personally that you could see a play if you're needing to get into real estate, you're needing to buy a home in the coming months. Or sometime, quarter 1 or 2 next year, is maybe a really optimal time for you to buy for a long-term purchase.
You think quarter 1 or right now, between now and then?
Between now and the end of quarter 2. Quarter 3 and quarter 4 next year, you introduce some different effects with the presidential cycle and election and the effects that could have on the market.
I thought my assumption, this is my analysis, is that the current administration is going to do, no matter whatever the political party is, but this current establishment is going to want to have a positive economic situation going into election, right? If November is the election. So if I'm going to look at this as a timeline and I'm the puppeteer, right? And I can move these levers a little bit more, I can control these levers a little bit more than other market forces. I would say I'd rather see the interest rates go up over the first part of the year to mitigate it pulling back at the end of the year.
I think it's not going to happen that way.
Fair enough.